Welcome back to The Big View. It's our first episode of 2026, and at the start of the new year, it is customary to engage in some traditional activities. I'm not talking about making New Year's resolutions, or embracing a fresh exercise regime, or giving up alcohol, or anything like that. I'm referring, of course, to the question that tends to come up every January: where are financial markets going to go in the next 12 months? Making predictions is always tricky, and forecasting the direction of stocks, bonds, and commodities is generally a humbling experience. Just look at what happened in 2025. President Donald Trump came into office, delivered the tariff shock many had assumed was just a negotiating ploy, alienated close US allies, attacked the independence of the Federal Reserve, and pushed through tax cuts and spending commitments that will add $3 trillion to the US federal debt. Yet, by the end of the year, the S&P 500 index had gained about 15%, and the yield on 10-year US government bonds was lower than at the time of Trump's election victory. Only the weaker dollar and the soaring price of gold offered a hint to investors that something has shifted. So, any prognostications about the direction of financial markets in 2026 should be approached with caution. Indeed, just consider the Trump administration's abduction of Venezuelan President Nicolas Maduro. Nevertheless, that's the question we're going to tackle on The Big View this week. It's what we do at Reuters Breaking Views. We tap our best sources around the world for fresh insights into the biggest questions of finance, business, and economics. I'm your host, Peter Thal Larsen. So to talk all this over, I'm joined by Anna Szymanski. Anna is editor-in-charge of Reuters Open Interest, the go-to provider of data-driven expert commentary on the trends driving global markets. She's also a co-host of Morning Bid, the new daily podcast from Reuters, which explores in great detail all the gyrations in stocks, bonds, and commodities that are happening every day. Anna Szymanski, welcome to The Big View.
Thank you for having me.
And Happy New Year.
Yep, Happy New Year to you as well.
Have you got any good New Year's resolutions?
My New Year's resolution was to sleep more, but I will say the news that started this year made it so that I have already broken that entirely.
Yes, I know. The year started with a literal bang. In Caracas, which we should talk about, the sort of the geopolitics. But I just want to start by just sort of zooming out a little bit and just thinking about the sort of the general mood, because it just seems to me that everybody's incredibly bullish.
It's true. Which, to be fair, I think one could ask, why not to be? Because if we saw what happened last year, where we had many things occur where one would have thought it would have, created some type of lasting correction in the market, whether you're talking about tariffs, whether you're talking about multiple geopolitical issues, but it simply didn't. And a lot of the forces that were driving the rally last year are continuing, and we're likely to get rate cuts this year. So if you're thinking of relatively strong earnings growth, you're thinking of, the AI theme almost certainly going to continue, and potential for rate cuts. That's a recipe for a bullish environment. Yeah.
So the kind of the resilience of the economy and of the markets in 2025 has sort of got everybody thinking, well, that will continue, basically.
Yeah, and I know one thing that Mike Dolan, who I do the Morning Bid podcast with, and I've talked about frequently, is also this question of, you have a generation of traders now who have never seen a time where it wasn't a good idea to buy the dip. So in that environment, what has to occur so that people won't buy the dip? So you certainly could have volatility, and I think we probably will have volatility this year, but will you have any type of sustained correction? It seems unlikely.
Yeah, although I will say, we should get back to that. I mean, that sort of psychology question is really interesting. But you do see when you sort of see a kind of a consensus that's overwhelmingly in one direction, it does make you wonder a little bit. And I was reading the Bank of America does this monthly fund manager survey, and I think the fund manager survey for December said it's the most bullish survey they've done in 3.5 years, and like the participants, their cash holdings was the lowest it's ever been. it kind of makes you think that it doesn't take a huge amount to maybe knock people off their stride.
No, it's true. I do think you could say that things are priced for perfection. And in that environment, one would expect there to be more likely that you could get underperforming downside. But I also feel like in the last few years, I've heard this kind of story quite a bit of where, credit spreads are the thinnest they've ever been. X is the most it's ever been. And the rallies just continue.
Yeah. Yeah. So you mentioned the Venezuela surprise, or maybe it wasn't that much of a surprise, but definitely caught people by surprise in January. And obviously last year we saw a lot of sort of geopolitical shocks, right? So trade war. We saw we had Ukraine still going on. There was the war between Israel and Iran. Various other kind of shocks, and it almost makes me wonder, like, what would it take for a geopolitical event to really affect markets?
Right. And I mean, I think if you're talking about energy markets, which has been a place that in the past geopolitics have had a pretty big impact, I think in order for it to truly impact prices, it would have to impact, if we're talking about oil, the actual barrels in the market. If we're talking about any other commodity, it would have to impact actual volumes. What I think we've seen, I know Ron Busso, the ROI energy columnist, has written about this quite a bit. What we're seeing is actually that energy markets are becoming a lot more rational. They're not reacting to headlines the way they used to. Maybe you'll get a one-day move, like when you had the U.S. and Israel strikes on Iran, you had an immediate move, but it didn't last. And it didn't last because traders could see that this probably wasn't actually going to impact supply, or it wasn't going to impact supply enough to truly move prices. So I think if we're talking about energy markets, you really need something that is actually going to impact, barrels in the market. When you're talking about equities, it's another question, because you have to say, if we're talking about the S&P, well, then we're basically talking about 10 companies. So what has to happen that's a geopolitical event that is going to impact Google's earnings? Or what would that have to be? And I think it's an excellent question. And I think you would probably think it would have to be something, definitely involving the US. I think maybe this is where we can talk maybe a little bit about the Fed, where something actually involving the financial system, maybe what it would actually have to be.
Yeah, or something that affects the economy more broadly, which I guess we got a glimpse of that in April last year, right after the Liberation Day. So people worrying about inflation, kind of stocks fell, bond yields went up. There was a sort of a shock that did seem to affect, or at least people were expecting it to have an economic impact.
And the interesting thing there is that you did have a week where frankly, it almost felt like the pandemic, where it almost just didn't seem like there could be a bottom. No one knew what was going to happen. And then as soon as Trump came in and delayed things, obviously everything bounced back relatively quickly. And what we have seen is that tariffs are a lot higher than they were. Now, granted, we haven't seen the significant economic impacts that people might have expected, but you do have higher tariffs, and markets now have kind of come to terms with that. In a way, I feel like what happened in April was really a response to how the tariffs were presented. I think there was a lot of concern about the seriousness of the administration, given how they were presented. And then I also just think the surprise, whereas once you had the administration, you could argue, act somewhat rationally in terms of pulling back, markets responded in kind. And also what we've seen in the whole taco trade from last year is that you do have a lot of investors now thinking, okay, what we saw last year was that if markets really push Trump, he pulls back. So markets are going to act with that in mind. So what would have to happen? You'd have to have something happen where Trump was just not responding to the market. And that actually seems unlikely, because one of the things we've seen is that markets, especially the bond market, is something that can actually curtail Trump. Congress might not, but the bond market seems to.
Yeah. International law, not so much, but the bond market we pay attention to.
It's like James Carville quote, coming back is the bond market.
Yeah. But that's sort of interesting because, well, there's a couple of things there. I mean, first of all, maybe just on the geopolitical issues. I mean, there is a sense that none of this, as you say, none of these things individually really matter. Israel bombs Iran, but Iran doesn't block the Straits of Hormuz. Therefore, the oil price is unaffected there. Everything goes on. They abduct the president of Venezuela, but Venezuela's only 1 million barrels of oil a day or something like that. And so, that's not going to change dramatically anytime soon. So that doesn't affect people. I saw a quote from someone talking about Cuba, the possibility of regime change in Cuba. And it was sort of like, well, unless you care about beachfront property, it doesn't really matter in terms of financial markets, which is a pretty cold-hearted way of looking at things. Indeed. But there is something in that none of these things really add up to something that's going to your point, to sort of derail the economy or to derail corporate earnings.
I guess the risk, though, as I listen to you list all of these things, is it kind of that apocryphal story of the frog in the boiling water, where markets are just like, it doesn't matter. But do you get to a point where all of a sudden it does? All of a sudden, all of these things added together are creating a very different environment. And frankly, if you look throughout history, we have seen incidents where those kind of things have happened, where you've had things slowly build. No one fully understands what's happening until you get to a point where something, something extreme in markets happens, because markets have understood that something fundamentally has changed in how the global markets are functioning.
Right. And there is a sense with Trump that maybe he's more constrained on the economic stuff, right? So he's a bit constrained in terms of the tariffs, because when the bond market's affected, he pulled back. There's also, there's going to be a Supreme Court ruling on whether or not his emergency tariffs are legal. He's a bit constrained on the Fed. It sounds like he's going to probably appoint someone from a short list of reasonably sensible candidates to be the head of the Fed.
Likely someone named Kevin, narrowing it down. And then, and it's not entirely clear that the Supreme Court is going to let him fire the governor, Lisa Cook. So there are sort of these, and obviously anything he does on spending and on taxes has to go through Congress still. So it's always, he's quite constrained there. But when it comes to foreign policy, he's sort of unleashed. And you wonder whether the sort of, the fact that he is able to do this thing in Venezuela without any real consequences will make him think, well, I can do that somewhere else as well. Yeah, perhaps Greenland.
Right.
No, I do think there's a real risk of that, because I completely agree with you. If he's struggling to push through his agenda domestically, he has had some, one could argue successes in some way, like you do have the ceasefire deal in Israel and Gaza. But you also do now have these type of actions like we're seeing in Venezuela, which I think are quite questionable. And I agree with you. Does he start to, use where he has degrees of freedom? He uses those. And I do think that definitely is a risk.
Yeah. So it's hard to talk about markets in 2026 without talking about artificial intelligence. It was obviously the kind of dominant theme of 2025, as you mentioned earlier. And I think I saw there was some. I think Deutsche Bank strategists had done a survey of their clients, and sort of the possibility of an AI reversal was by far and away the number one sort of risk that people see going into 2026. So how should we sort of think about this, and how should we think about, I guess, the knock-on effects possibly?
Well, I think on the one hand, of course, it would be the biggest risk because it's the biggest driver.
Right.
So kind of by definition. Right. And also it's a driver that's not entirely based on facts on the ground. It is based on a lot of expectations and hope and belief that this is going to revolutionize things, that this is going to massively increase productivity, that whoever wins this race is going to win the new economy. And maybe all of those things are true. But, I'm not the first person to say that one of the things we've seen in the past when you have technological innovations, revolutions, is that too much capital flows in. There's overbuilt, overspending, whether we're talking about railroads or whether we're talking about the internet. This tends to be what happens. And then you do get to a point where some type of bubble is created, because basically the real world hasn't yet caught up with the financial world. And so you do have some type of significant correction, and some people lose money. But ultimately, society kind of moves forward, because in a way, the only way that society can move forward is if you have technological advances. And the only way those can occur is if people think they're going to make money, and so they throw money at something.
Yeah.
And so you then are creating the structure that could lead to this kind of AI-driven economy of the future. So it's that it could be correct that AI will completely revolutionize our lives. And it's also probably correct that a lot of people are going to lose money in the interim.
Yeah. And I think that's a very important point. And that's something that's a bit lost in this endless debate about, is it a bubble? Is it not a bubble? because you can believe in the sort of the possibility of technological improvements, and also believe that Meta is probably going to not make money on the hundreds of billions of dollars it's spending on data centers.
Right.
But on that sort of latter point, I mean, there's a lot of belief behind it, but there's also a lot of real investment in capital.
Yes, this is true.
Right? I mean, this is not like, oh, we made some software and people think it's going to be really successful. It's like, no, we've spent a load of money buying chips and building data centers and buying the power to power the data centers and so forth. So, I mean, that is quite consequential.
Yeah, and it's a very real world impact. I think when we've thought about technological innovation the last 20 years, I think we're often thinking of software, we're thinking of the cloud, we're not thinking of the physical world. Whereas AI, because of the just massive energy needs, and also the need for critical minerals and rare earths and all of these things that are used in the actual building of the technology, is really, really connected to the real world. And on the one hand, you could make the argument that that could actually create more employment than people might think, because someone actually has to build these data centers. I would imagine AI can't quite do that yet. But it also really raises the question of, what does that mean? And going back, actually, frankly, to our geopolitical debate of, if now you have this world where access to resources becomes so important that it's going to really alter how governments work, it's going to have to alter how investors think. Because I don't think, I mean, of course, investors in specific areas have had to be concerned about real world items, but I think in general, there hasn't been this much of a focus on access to resources that there is now.
So just sort of play that forward a bit then. So what are the consequences of that? Because I guess the way I think about that is we've historically, in financial markets and in sort of business generally, people have optimized for efficiency. The chip industry is a perfect example of that, right? Like you sort of like, there is one company in Germany that makes the mirrors, and there's another company in Japan that makes the silicon wafers, and they all sort of operate on this assumption that they can source their materials and they can ship things around the world in a very sort of efficient way. And if that changes fundamentally, then what you have, what you're left with is something that's less efficient and therefore presumably less profitable.
No, I think I completely agree with you. I think that's a very real risk, that the kind of things that, again, even if we get to some AI future, the interim could be very, very messy. I think specifically because of that, because what the focus on AI has done has increased the kind of, in a way, breakdown of globalization that we've been seeing, even in the years leading up to that. As you were saying, in the last few decades, there has been these long supply chains, but whether it's from the pandemic and the AI revolution, all of these things, you're now seeing this pullback. And it seems like that's probably going to continue. And that is something that I don't think investors have fully wrapped their brains around yet, partly because it's actually very challenging to do that.
So you have a team of columnists at ROI, some of whom basically are focused on materials, right? On oil, on metals, on renewable energy and things like that. So what insights do you sort of see bubbling up from the work that they're doing that maybe investors should be paying a bit more attention to?
Well, one thing I know Andy Holm, who writes on metals, has really noted is, number one, how currently, I think it's 80% of the tradable elements on the periodic table are now classified as critical minerals by the US. It's just some remarkable number. But also how the way that companies use these materials has really changed. That in the past, we were thinking in enormous volumes and smelting all this metal. And while, of course, that's still occurring if you're thinking about iron ore in China, a lot of the technology now needs very small amounts of a number of these rare earths, those kind of things.
Yep.
And that's why you'll sometimes hear people kind of poo-poo the rare earths question by saying, oh, well, but if you look at how the actual just value of these things, it's relatively small. But you only need a small amount for the most important products in the world. And so I think people need to really kind of wrap their brains around how these elements work in the products of the future, whether you're talking about AI, but also whether you're talking about a lot of the renewables technology. And another thing, and this is something that, Gavin McGuire, who's our energy transition columnist, and also Ram Busa, who writes more on traditional energy, have both kind of talked about and written about, is this idea that what we're seeing in the US is that we're essentially moving backwards in terms of our energy policy.
Mhm.
That we're going back to a environment where we're only focused on fossil fuels. We're not investing in renewables. There's this assumption that fossil fuels will not plateau, perhaps ever. Whereas you have China obviously doing exactly the opposite, where you have seen China actually up like their use of coal, but the reason they're doing that is so they can electrify faster. Clearly we see where they're headed, and they're also the ones creating all of the goods that will have to be used by everyone else who wants to switch over to renewables.
Just explain that bit. Why do you need coal to electrify faster?
Well, no, it's because it's cheap.
Right.
If you want to electrify more quickly, you want to use the cheapest possible energy.
Oh, I see. Okay.
So it's, again, you could look at it on the one hand and say like, oh, clearly they're not focused as much on renewables, but that's, I think, looking at it incorrectly. That's something like Clyde Russell, who works on Asian commodities on my team, has written about quite a bit.
Right. So it's just that let's generate as much electricity as we can.
Exactly.
Right.
Exactly.
Okay.
So I think this is really going to be obviously one of the biggest stories in energy probably for the next decade, that, as of right now, it frankly looks like the US is really making a major own goal, for want of a better term, that it is really helping China, essentially, because it's pulling out of this race. And I think that that's something when we're thinking about the position of the US moving forward. People talk about the dollar, they talk about all of these other things in terms of the potential for US to lose dominance, especially in a world where access to relatively inexpensive energy is so important. The idea that the US may be really taking just not necessarily even the wrong route from an ethical perspective. You could say maybe for climate change, but even setting that aside, just economically, they may be really shooting themselves in the foot.
Yeah. No, and that's definitely is also this interesting question about the role the US plays if it's sort of if it's basically saying, well, these new technologies, whether it's solar panels or batteries or whatever, we're not going to compete with the Chinese on that. Then how do you influence a world economy if you're a little bit in the sort of in a cul-de-sac on that?
No.
So that's an interesting question. I think we should talk about. We obviously can't talk about markets without talking about credit. And obviously, you used to work at Oaktree, the big alternative asset manager. And I feel like I've sort of heard probably around this time of year from distressed investors. Every year, it's like, okay, this is the year it's all really going to crack. And there was 2022 when interest rates went through the roof, and I was like, okay, finally the period of low interest rates is over. Now the kind of chickens are going to come home to roost. And we saw a few hiccups, or what they were called cockroaches, last year, but we haven't really seen anything really happen. So how do you think about that for the year ahead?
Yeah, no, it's an interesting question. I mean, as of right now, frankly, it looks like maybe there was only one or two cockroaches.
Right.
So when you did have interest rates go up significantly, there was a lot of talk that we are now in a higher for longer environment. We are now in a new environment. You basically had 40 years of lower declining interest rates, which really did undergird the growth of private credit and, frankly, the growth of private equity. And now we're moving into a new environment. And I think a lot of the fear and also the expected opportunity for a lot of distressed debt investors was the idea that you had capital structures that were put in place with a completely different world in mind, especially things out in 2020, 2021. Frankly, we just haven't seen the type of collapse that one would have expected. I think there's a lot of reasons for that. I think partly it's because there are just a lot more mechanisms and ways for companies to work with their creditors. You saw, tremendous growth in distressed exchanges, those kind of things. So you just simply aren't seeing the types of collapses. There are more, there was all this talk about covenant light. Well, the one nice thing about not having a lot of covenants is you can't breach them.
Yeah.
So it actually can be somewhat beneficial when you get into rough times.
No, and we've definitely seen that. Some people who have companies that have way too much debt. Patrick Drahi, the telecom entrepreneur in France, is a good example. But he has so much freedom to move stuff around that basically, his creditors just have to kind of accept it.
Now, granted, if you're extremely low in the capital structure, you may end up finding that your recovery values are much lower than you would have anticipated. So it's not that there couldn't potentially be losers, but the issue is, are you going to see some type of collapse, some type of crisis. And again, going back to something I said earlier, that, credit spreads have been very, very narrow. And so that always raises this risk. But again, you look at the companies that have a lot of this debt. Now, of course, there are going to be some that are weak, but a lot of them are also very strong companies. And the idea that these companies are going to potentially default is obviously extremely low.
Yeah.
And so I'm not saying that you couldn't have some type of downturn in credit markets, but are you going to have something like we saw in 2008 or probably not? I just think you aren't seeing the type of the spike in default rates. Almost in the last few decades, I would say you're actually seeing really a decline. So even when you do get a bit of a downturn, you just don't get the same spike in default rates that you did in the past, which doesn't mean that there couldn't still be opportunities for some investors, but frankly, they're probably going to have to be smarter investors. They're probably going to have to do a lot harder work. It's not shooting fish in a barrel, which frankly, at certain periods of time it was.
Right. So I just want to come back to the sort of buy the dip mentality you were talking about earlier, because it does also feel like there's been some sort of shift in kind of investor psychology, and you can say, well, it's social media or it's the prevalence of trading apps and retail investors, and they kind of start with crypto and then they end up sort of buying options or whatever it is that they're doing. But there does seem to be the sense that some, at least in some areas, the markets can detach from financial reality and stay detached for quite a long time. So I guess I wonder if you're sort of thinking about markets, do you just have to sort of accept that that's the world we're in now? Or?
It's a really interesting question. It's always very dangerous to say this time is different.
Right.
We all know that. Very difficult words to say. But at the same time, investor psychology is obviously going to be based on the experiences of the investors of that generation. You had, it took decades after the crash in the 20s for anyone to invest in equities again. You definitely, after the dot-com crash, you had people, pulling back for, relatively significant period of time. But if you're talking about the main body of investors who are working now, they simply haven't had a lot of those experiences. They've had certainly significant downturns, whether it's 2008 or whether it's the pandemic. But in both of those instances, particularly starting with 2008, they saw that if things got too bad, the government would come in. And I really think fundamentally that's what's changed, is that now there is the expectation that regardless of what anyone says, the government is just simply not going to allow things to crater. And that is a little bit dangerous, because the reason that you earn a premium for equities is because you're taking a risk. If your assumption is that, well, there's not really any risk because I know that the government's going to bail me out, number one, that's why then are you earning that risk premium? But number two, it probably means you're going to take a lot more risk. And so there is definitely the worry that could lead to, some type of massive correction. But the thing I always come back to is, what stops the government from being able to step in and bail out investors? Especially now at a time when equity holdings are a lot more broadly spread out through, in America, a lot more people now hold equities, have a lot more of the wealth in equities. The idea that the government is going to allow, some type of massive collapse, it just seems incredibly unlikely. Now, that doesn't mean you couldn't have a 15% correction here, a 10% correction there, certainly, but something that's sustained, almost, again, it seems unlikely, because what I'm saying is not revolutionary. Everyone who's working in the markets thinks the same way. Also, a lot of the markets it's not people anymore. Yeah. You have machines that are trained on certain things, so they're going to behave in, potentially more rational way. Now, of course, we had things in the past of portfolio insurance and all these things where they thought they were super smart and then it fell apart. But I think, frankly, what's happening now is much more sophisticated than that. Now, does this mean we will never have a, true market crisis again? Obviously not. We all know that, I'm sure we will, but I'll be honest, it's very challenging to try to think of what would actually cause that.
Yes. Yeah. I mean, it is important that you say a lot more people hold equities and kind of have portfolios and stuff, but it's still, there's still a lot of people that don't. And so that there is, I guess, the sort of distributional politics of that kind of bailout mentality could get tricky at some point.
It's true, although the reality is that the U.S. for especially the last few decades, and one could argue its entire history, is going to give a lot of credence to the people who hold power, who have money.
Yep.
And those are going to be the asset holders.
Yeah.
The idea that that's going to change unless, you have a true revolution in the United States, again, it seems unlikely because, yes, was there tremendous discontent after the bailouts in 2008? Certainly was. Could you argue that has led to a lot of things post that? You certainly could. But again, I think leaders need people to donate to them to become politicians. So
yes, no, that system is that's pretty embedded. Well, Anna, this has been great. Thank you very much. Real sort of kind of tour of the horizon. And I guess I'll come back and check in with you regularly and see how it's panning out compared to what we expected at the beginning of the year. But thanks very much.
Yeah, no, looking forward to it. Thanks so much for having me.
That's it for our first show of 2026. Thanks to Anna for that great and very insightful conversation. And thanks, as always, to you for tuning in. This episode was produced by Oliver Tasich with support from Mike Copeland, John Hodge, and Sunita Barthford in the studio in London. For more fresh insights into financial markets, check out the Daily Morning Bid podcast and all the commentary from the Reuters Open Interest team. And also look out for our sister show Viewsroom and read our views every day at breakingviews.com and reuters.com.